pretty big week. We had FOMC this week. We got a revision to the dot plots. The market's kind of pulling back a little bit on over the holidays, futures at least. We did get a bit of a reversal from the news coming out with Iran, but the way that I'm seeing things going, like we're seeing the liquidity conditions index dropping. Like that's really what I've been that's what really caught my eye, at least, like seeing how the Eurozone is going and then now seeing how the US liquidity conditions are dropping. And we just saw the market dropping like before the news came out. We saw futures dropping. So I'm thinking this might be the time for a pullback. I don't know. Obviously, the liquidity conditions aren't always, like sometimes they are, but they're not always a leading indicator. But I feel like in this case, like the market's overextended. In this case, it might be a leading indicator, and that's really what's been catching my eye lately.
Yeah, I just want to disclose that just because one region goes down doesn't mean there's no correlation following, even though it looks somewhat correlated, right? Generally, like just because Eurozone's down here doesn't mean United States is going down here, right? That's just
Yeah, for sure.
don't don't overlay them. But like, yeah, you're right. Like, look, we've been pinned at the upper range for I don't know, what is this, like a month and a half, and then yesterday was really last couple days was really the first decline, and Nasdaq looks kind of stretched, but my um service level approach with this always is as long as we're above mid vamp, don't expect a lot of damage. And that's just what we have to that's really where we have to keep our expectations at with the Nasdaq. So um an example of that would be Bitcoin, right? So Bitcoin had held mid vamp all the way up, and it lost it at the end of May 29th, and then it kind of just had trouble reclaiming that. And that's just a sign that consolidation is the likely outcome. And given we couldn't really hold above mid vamp at all, outside of a couple of sessions over the last like month, this is or half a month at least. This is just a sign that consolidation is continuing. And you could see here, like it's obviously getting bought off the off the lows. It's wicking, so it's not that it's bearish. Just because you're under mid vamp, it doesn't mean it's over. It's bearish. It's time to get bearish, or it's time to sell. It just means, look, the and if you were to measure momentum on a long-term trend basis and short-term basis, being price above Momo, it has long-term bullish trend but short-term neutral momentum. Therefore, it's not going to go anywhere, right? Because if you think about it like this, you're not going to get new highs without going above mid vamp. So it's that simple. As long as you're below it, you're not going to get new highs. So just it's more of a conservative approach is what this means.
Yeah. And especially with the regime that we're in right now, like at the end of the day, we are still in a slowdown, which Bitcoin has done fine during a slowdown. Like that whole run up in May happened during a slowdown, but it does have a bit of a weighted vest in this regime.
Yeah. I mean, at the end of the day, risk as a whole, we don't necessarily have that positive risk environment yet, right? Like we don't necessarily have um that risk on regime fueling equities higher, which is what you notice here. If we take a look at our growth impulses quickly, right? So our growth impulses really stopped going up on May 15th, roughly. Like we did a lot of work between April 5th and May 15th, and we've gone sideways since, right? So like if you take a look at the the Nasdaq since like May 5th, right? We had this pop up, but we haven't really gone anywhere since May 15th. Like the rebound in the market has seemed to have coincided with our growth impulse rebound, and we haven't really gotten that. It's not like we've legged above all-time highs on the Nasdaq. And we just seem to have this churning action where we're not really going up much, we're going sideways, and this is gives the illusion of a very toppy feel in the market, right? It's like, oh, okay, like when stuff like this happens, it's either basing really, really well for a breakout, or you're going to get some sort of breakdown. That's what's going to happen here. And the key to this, in my opinion, is mid vamp. If you're under mid vamp, I think things may become a little heavy, and we might even be able to see like a lower vamp push. Momo's a bit aggressive. It's 6% decline, but it's possible, right? That's where I'm looking at risk like that at the moment. And Bitcoin's same thing. Like as long as Bitcoin's under mid vamp, it could go to lower vamp, 100K quickly. Maybe if it's just a day or two and bounce back, very possible. And I think that's the importance of having the regime in your sales leverage, right? Like it might be you in the next 12 months, this might be a good spot to buy with leverage. Like let's just say NASDAQ, right? Like 12 months from now in the future, you might be able to look back and say, oh, you could have leveraged up here and you would have been fine. Very possible. Or you could have a 6% decline and then maybe that decline goes back to chop and it was a terrible entry. And those declines in chop typically coincide with you not having that regime in your sales. So we aim to leverage up when the regime's in our favor. And right now, it just really isn't there for risk assets.
Yeah, and that just highlights the importance of not front running the system. Like, even though the system and the growth index is super close to going above Momo and flipping bullish trend, it's like this has happened before, like where it taps Momo and then reverses from here. And that's a high possibility. So it's really about allocating towards assets that work during risk on regimes in case we flip into a risk on regime, but also work during slowdowns in case we reverse from here. Especially when you're using leverage, you want to kind of play both sides. You want to hold on to assets that are not going to get completely destroyed in one of those cases. They should do probably not really well, like it's not like we're long the NASDAQ and we're going to get the full upside of the NASDAQ if it goes risk on, but at least being long something that does well during risk on, but also does well during slowdowns.
Yeah, and that's an important thing that you just touched on because look, the thing you have to understand with the system is the system is a representation of cycles over the long periods of time, right? You know, basically since the 90s. And it's an evolving system. So just because like here's an example. Just because let's just say we're in a stagflationary slowdown as of the last print, right? So if we go to the regime returns, we go to stagflationary slowdown, and we take a look at the representation of asset returns, these are just averages, regime averages. They're not necessarily, like law. They don't need to occur and they don't need to come to fruition in the same manner like every single time. Meaning, like energy doesn't need to be the best performer in every stagflation slowdown. It just happens to be a very good one over the long run of all the slowdown regimes we've realized. Now, the situation here where you have to take a step back and say, okay, well, like, for example, gold, right? Gold doesn't perform too well in stagflation slowdown, but each regime also has its own nuances. So I'm not saying these averages don't play out because then they wouldn't represent themselves this way. I'm saying that just because something isn't working in a specific regime doesn't mean the entire system is broken. It just means that there are perhaps some exceptions in this regime that are taking hold that don't typically happen historically. And this is the type of thing where you have to go back to the history often doesn't repeat, but it rhymes type of thing, right? So typically in a stagflation slowdown, energy will outperform, right? Utilities do okay. They don't do nearly as well as other sectors, but the situation is if you go from a stagflationary slowdown to stagflation, which requires growth falling back off from its balance, basically dipping back down, the playing field is completely reversed. So the tricky part about the regime that you're in right now, or that we're in, is understanding that you have a target buffer here where risk can do okay. Like I just showed you, financials, energy, discretionary, they can do okay. But if you really fall down to the lower categories, what ends up happening is you kind of just flip back to that risk off where like you have very strong or very negative reactions and risk, and the defensives kind of really do a lot of carrying, like staples and utilities and whatnot. So it's a very unique situation. These are the hardest regimes to trade. Anything with negative growth impulses are just generically hard.
Yeah. Well,
And
because risk comes really quick. Like it's very hard to have any system or model that predicts risk. Like there's a reason why volatility trades don't work. Like risk just happens insanely quick and you have to be allocated in the proper assets before that happens. You kind of have to just see it coming, like how our system does with a slowdown. And if shit hits the fan, shit hits the fan. And you got to be allocated in the proper assets when that happens.
yeah, in the last year, the last 6 months or so have been quite tough. At least from a systematic perspective. Like, so here's the contrary. Let's just say you're not systematically trading, right? Like, let's just say you're discretionary. You're just trading on a discretion basis. You come into the year, Trump starts making a lot of noise with tariffs, and you sell, and then you buy the dip, right? You buy anywhere sub 470 on QQQ. Automatically, you're ahead. Without it was a very easy discretionary alpha layup, in my opinion, right? Um, on the other hand, here the volatility and kind of choppiness has made systematic trading and approach a bit more difficult in terms of, you have to sit here and the headlines are changing constantly, and they're basically rotating regimes, or you're having the situation where you're having regimes within regimes, right? Like you can be in a risk off regime, right? Or generally speaking, you weren't in a risk on regime at all since December 24th, right? So if you go back to December 24th, that's when we left risk off. And funny enough, the Nasdaq is literally unchanged since we left risk off. So since the system trickled out of risk off, we have not actually gone anywhere on the Nasdaq. So it's the risk parameters in the model are fine. It's just what ended up happening when you have volatility like this, you essentially have this entire risk off and reversion or reversal within weeks, right? We're not even talking about months. We're talking about weeks where you almost go from severe risk off to severe risk on, but you actually go nowhere, which makes systematic trading, especially if you're trying to find durable cycles, a bit more challenging. But I assume a lot of the tariff noise is behind us in terms of some uncertainty. I know we have some deadlines coming up, but I think we'll get past that, and we'll be able to at least navigate smoother there from a systematic approach going forward.
Yeah. We pretty much just need like a nice long-standing risk on regime. And
Yeah, I mean, but
I
those are
think it's
normal.
coming. Like I think it's coming as long as uncertainty keeps coming off the table as it has been. I think we're going to get that risk on solid regime pretty soon here.
Yeah, and that's the thing about the market. The market is more risk on than anything else over the long term. So, we're just in a position here where, again, we had a very strong year last year. And, you could chalk this up. Look, you had a ridiculous 23 and 24, 25's consolidating, and possibly, you're just basically balancing out balancing out books up here, leveling out before you make another move up. I mean, you look at it like this, right? Like from the lows of 22 to where we peaked, and just at the beginning of 25, that's 100% on the from Jan 23 to Feb 25. That's 100% on the Nasdaq. It's like you're talking about what, over 2 years. Like the market's not going to annualize ridiculous returns like that indefinitely. So there's some consolidation that has to happen. I think that we started seeing that when we left risk on in December, and the fact that like we're still struggling to get to risk to the risk on environment now just gives me more confidence that the market's still at least consolidating, for a bit here. That's what it feels like, and it's just equalizing out. And it's good that we're above Momo because this is just constructive. So what's happening now is like you're setting yourself up for that when risk goes because remember, the system is independent of the trends. So if the system goes risk on and the Nasdaq is bearish, we will not go long. But as long as the Nasdaq stays bullish, any risk on signal in the system will basically force us right into the market, into risk, because we're already having one side of the leg confirming, right? The trend's already confirming. We're just waiting on the system now.
Yeah. And in terms of the system too, like we've got the inflation side of it already bullish trend, which that as long as we get that growth to pop up into bullish trend as well, like we are in the best possible regime, which
That's not,
kind
yeah,
of gets
that's
me
true.
excited.
Inflation regimes are so fun because I mean anything goes up. It's not like, don't compare it to post COVID. For any of you guys that were trading post COVID, that was a dream. That was an illusion. That was the Matrix. Okay, that wasn't real. Um, there were the amount of stimulus that the market literally everything was stimulating everything, like, between fiscal, monetary, corporations were upping. Everyone was getting stimulus from all different directions, right? You had pay grades going up, everything just ramping, market ramping, and that was really a situation that you're not gonna really see again, in my opinion. And that's a good thing to pivot into, like, the FOMC, right? Because Trump is looking for this, like, rocket fuel stimulus, and I just don't think he's gonna get it.
Yeah, like I think the Fed is highly on guard from the recent inflation spike that they had. Like they really do not want that to happen again.
And I mean, I understand what Trump's looking for. Trump, like, at the most simplistic level, Trump is comparing our interest rates, right, globally. So he's looking at Europe and he's saying, Europe's cut 10 times. Why has the United States not cut? And the question really comes down to, like, are you factoring in deficits? Because Europe's deficit is nowhere near America's deficit, right? And then you look at your fiscal path, right? Europe's fiscal path is just essentially heating up, where America has been on this fiscal path for some time now. And the Fed is almost playing defense without publicly saying, and we keep saying this in our podcast, but I truly think that Powell's I knew immediately last week when this Iran stuff started going down, like, that's the Fed was going to basically lean on that with more uncertainty. There's more uncertainty on the table, right? And they were asked about that, and Powell basically reiterated that there is additional uncertainty on the table. He also reiterated that tariff uncertainty is still not off the table. And these are all just angles that the Fed can lean on, and there will be more in the future that the Fed will likely utilize, at least during Powell's term, where they can circumvent having to address the fact that the policy is only restrictive because the fiscal is so loose. If fiscal was cut in half, the Fed would be forced to cut. It's not very complicated,
Yeah,
right?
they
The
just
problem
can't
is,
outright say that.
yeah, the problem is the last thing the Fed wants to do is get into basically a pissing match with the government, as with Congress, as to what Congress should be doing with their budgets, right? That's the last thing the Fed wants to do. And the Fed's trying to stay as independent as possible. Now, could there be some political motivation at the Fed? To say that the Fed is completely clean and unbiased is probably a mistake, right? Because there's bias everywhere. So you can't just say, like, oh, the Fed really doesn't. Look, put yourself in Powell's shoes and imagine, you just want to finish your term and you're just trying to make sure that inflation is under wraps and you don't screw anything up on your way out. And you're constantly being berated, right, to do something that, quite frankly, is a federal issue. It's a fiscal issue. It's not a monetary policy issue, because Powell, in so many words, essentially said, our policy is fine. We don't have to do anything because nothing's warranting our policy to do anything. I.e., unemployment has not, so the Fed cut 50 basis points in the Fed essentially cut into last year, right? Or into the end of last year. Unemployment has not gone up since then. Unemployment triggered the SAM rule last summer, spooked everyone out. The Fed was easing, right? And the Fed stopped cutting. But since the Fed stopped cutting, it's not like unemployment continued to rise. Like, unemployment's been pinned at or below 4.2%. And you can see here by their estimates, right? They expect some some loosening in labor still. Like unemployment for the median for 25 is still higher than where we are right now. It actually shifted up, right? So you're seeing the Fed essentially acknowledge that labor is going to weaken a little bit, and with their estimates of weakening labor, their policy path has actually gotten tighter. And this is primarily due to the transitory effects of tariffs. Because remember, when you look at the SCP, you're only looking 1-2 years out, which tariffs are short-term inflationary. They revert because there's only the price increases are transitory, right? If I put a 20% tariff on something, the prices go up 20% essentially across the curve, depending on if the manufacturer's paying or the consumer's paying. But then you also have supply and demand competition and stuff like that will offset the tariffs to the end consumer, right? They don't necessarily go up one for one for the consumer. And I think that the Fed is looking at this in their dot plot scope as a transitory thing, but the way it's coming across is you're seeing higher inflation prints, even though the long runs are going to be 2. And you go out to 27, you're seeing a 10 basis point shift in PCE. This is insignificant, right? In my opinion. And I think that ultimately the Fed is concerned about fiscal, but they can't say it. Like if asked privately, Powell has addressed the fiscal path, but if you were to ask the governors and even Powell privately, I would bet you he would say, yeah, like we're pretty much anchored by fiscal, because at the end of the day, if we cut, it goes right to the bottom line. There's nothing. Put it to you this way: the Fed cutting interest rates would be an act of stimulation, right? The Fed would be stimulating, would be making conditions easier. But if theoretically growth is running above the economic potential, right? What is the need for stimulating? What are you stimulating, right? And
Yeah, there's
ultimately,
literally no need.
no. And ultimately, I think what happened was the Fed. This is what happened. The Fed got scared when they saw labor cracking last summer. It was coming from a very low place, but the way it was moving, it triggered the SAM rule. And the SAM rule is just a momentum indicator in labor, right? So if we look at the labor, like if we look at the unemployment rate, the SAM rule is basically just an indicator of how fast labor's moving up. That's what it is, right? So when you trigger the SAM rule, historically it's worked pretty much every single time. When the SAM rule is triggered, it's a sign that employment will continue to accelerate. And this time it didn't, but we were coming from a very low point historically, so it kind of obscured the indicator. Nonetheless, the Fed started seeing this rise. I mean, from March to July, we were talking about a 30 basis point rise in the unemployment rate, right? So this is something that the Fed saw and was scared. And I guess, if you were them, maybe you would be too. And they cut rates. And when they realized, when labor started doing this, they were like, okay. And labor eventually didn't even go higher. It wasn't just a one-off print. It was confirmed that this was not breaking out. They pulled back. Now, some will call that political motivation, right? Some will say, oh, well, that was right before the election. But at the end of the day, the SAM rule also triggered right before the election. So
Yeah. And historically, like once unemployment starts rising, it doesn't really stop. If it's an actual recession, it's not going to stop like this. And I think they realize that.
And I think to some degree, Trump's actually doing more harm to the Federal Reserve than, how do I phrase this? In the easiest way to phrase this is, inadvertently, Trump is actually hurting the image of the Fed more than he is helping. Now, you can call central planning an illusion, bunch of garbage. The Fed's, a bunch of secret bankers. Whatever. There's a million things you can classify them as. But at the end of the day, their job has only gotten harder with tariff uncertainty, right? In the fact of, like, the effective tariff rates can shift within a week. If, for example, if Trump cut all tariffs tomorrow, what do you think the Fed would do?
Oh, dude.
Maybe they would.
The market's going to be at all-time highs, first of all.
Right. But the Fed would be then faced with another policy path where maybe they can reduce rates slightly. But at the end of the day, I think what Trump is really anchored or hooked on is this. This is what Trump is hooked on. The Fed funds rate is 4.3%. He doesn't understand why the Fed funds rate is here and not where he was when he was the president last time at like 2%. That's why he's saying the Fed should cut two percentage points, because in his mind, that's where the Fed was the last time he was in office. But the last time he was in office, we didn't have a 7% deficit. So the reason the Fed is up here, and the reason you can argue the reason the Fed is up here and nothing has broken is the deficit.
Yeah.
If the deficit were to get cut in half, the Fed would have to cut aggressively.
Yeah, they're going to have to catch up.
But that's not the case at the moment. So I think that's where we are with the government situation. And the Fed is, look, Powell even says these forecasts are meaningless because something can happen next week and the forecast will change. But this is just an indication as of the meeting, right? Going into the meeting, what the board generally expects. Again, if Trump were to remove all tariffs this weekend, this would be changed. The whole thing would shift. So I think we have to just take this with a grain of salt that there's a lot of dynamic things that can happen in the market. And ultimately, the situation right now with risk, like you just said, if Trump were to take tariffs off, NASDAQ's at all-time high, which is funny because like the NASDAQ's almost at all-time high. So imagine if Trump took the tariffs off, we'd be at like 560 on the Qs. Easy,
yeah, like in a day.
In a day. But I don't think he's going to do that. And I think that there's this situation now where you have inflation essentially showing signs of resurgence, which this is not like when we say stagflation slowdown, we're not talking 1970s stagflation. Like that's an anomaly. We're talking just a general environment where inflation impulses are stronger than growth impulses. And in that environment, there are certain sectors that tend to outperform, but ultimately, we are still in the slowdown environment, which is important. So we are still in this box here. And this is a box where things like Bitcoin can do well. And as you saw earlier, some other sectors, but we are also not very far from risk on. So the market might be setting itself up for maybe even a dip, a risk on pivot, and a rip. And that would be the most ideal setup. And that would be something that we'd love to be long. And hopefully we do get long. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X @TheMarketRadar or go to our website at market-radar.com.